Hello and welcome to a brand new episode of ET Markets AIF Talk, a show where we discuss the opportunities as well as investment strategies deployed by the fund managers in the popular space of ultra HNI investing. Well, my name is Shadajanand, and today we have with us a very special guest, Arun Chulani, who's a co-founder, First Water Capital Fund. Welcome to the show, Arun.
Thank you. Thanks so much.
Thank you so much for being part of this segment, Arun. And first of all, let me start off. What is the investment philosophy of First Water Capital Fund, that is Category 3 AIF?
Sure. Well, at our very heart, we are value guys. But of course, we're just not looking for cigar butts, as it may take a long time for value to unlock. But we're really looking for funds that are reasonably well valued and have either growth within the sector, within the company, or an inflection. So something has to be out there that unlocks the value. And of course, we're then a concentrated fund. So if we like something, we want to take a concentrated swing at it.
Right.
For us, at least, there's no point having 50, 60 stocks. And if one does very well, it has very relative little difference to the performance of the entire portfolio. But if you're able to concentrate and really identify a good stock and really believe in it, then one, you can build your knowledge in it. And two, if something happens, if it has a good performance, then it makes more of a concentrated impact on your performance. And
Right.
yeah, I mean, that's really it at the heart.
Right. In fact, I was also going through the fact sheet, and if I look at from a 2 to 3 year basis, the dollar returns have been really impressive. So, did you tweak your strategy amid the recession and slowdown woes globally?
We didn't do anything special per se because we're not really looking at the macros as a whole.
Okay.
Of course, at the very heart of our philosophy is the macro, but looking at it in the short term, if Jerome's going to put up rates by 1/4% or 0.5%, or what's happening in the near term,
Sure.
isn't really in our strategy because we really rely on these guys, the central bankers, to really run the show from that perspective. And they're pretty smart guys. Clearly, that's why they're in that position. So, of course, it's down to them. But we couldn't ignore the headwinds, whether it's conflict, inflation, interest rates, recession, perhaps, and all that. So we did increase cash marginally to create some kind of drag and volatility, but very much because we're very long believers in terms of the India story, which is
Okay.
5, 10 years. That's what we really are holding on to. And yes, there may be volatility, but in our minds, as long as there's no structural change to the underlying companies and the underlying country, then for us, it's very much notional losses. So we just played the game as intended.
Right. And now that we have you right in the show, we cannot ignore, and we have to ask you about the Indian market because you interact with a lot of foreign institutional investors globally and here in India as well. So how are FIs or HNIs are looking at Indian markets? What is the kind of feedback you're getting from the investor community for India?
Sure. So very much, I've been speaking to quite a few of them, and some of them based in the US. And while
Mhm.
India really, at least it does seem it's not in their portfolio, but it's very much on the precipice. It's something that hopefully you can't ignore,
Okay.
considering what they're experiencing in the West as well as in China. For US, they very much think the economy or investing is very much
Mhm.
US centric, and then there's the rest of the world,
Sure.
whether it's Europe or Asia or emerging markets. But
Mhm.
India itself, from my feedback, is very much on the tongues. They're listening to it. It seems to be quite a bright spark and a shining light, considering what else is out there.
Right.
For the last 10, 15 years, investors who've been long the FANGs have been
Mhm.
rock stars. But this might be a welcome paradigm in a high liquidity QE type environment. But in an environment like today, where there's a bit of QT going on, there is inflation and various
Mhm.
other aspects. It's really now that the fund manager has to do his job. And also in a country like India, it seems pretty robust. There is a domestic engine in terms of demand and growth, young population, 29 years, and a lot of push in terms of infrastructure. So from what I'm hearing is there is hopefully that pull towards India as an investment kind of focus.
Right. Especially when you're managing a portfolio and you're a fund manager, there are two matrix or two factors which are very important. One is risk and the other one is the exit strategy. So how do you manage risk and what is the exit strategy that you have?
Sure. So as you rightly mentioned, these are two very important, and we take risk very, let's say, seriously.
Mhm.
And it kind of goes hand in hand with in terms of the exit strategy. For instance, for us, we look at the portfolio as a whole in terms of risk and reward on a relative basis. So we're not just sitting there buying and holding a stock and just waiting 5, 6, 7 years. We're always looking how the stock is performing, and because we have a concentrated portfolio, we have a lot more time and ability, hopefully, to really understand our stocks and its intrinsic value. So if a stock runs ahead of its intrinsic value, we're looking to trim. And if it's lagging, we're looking to add. So looking at our complete universe in terms of our portfolio, we're always moderately moving our position around to make sure that we are hopefully maximizing that risk reward basis on a portfolio basis. And secondly, when do we look to exit? Clearly, there are many ways of looking at a stock. A lot of people can do a DCF or multiples, but there's both the art as well as the craft of the market. And there are many paradigms and very many moving parts and dynamics when you have to look for an exit. So when you're looking for an exit, again, if a stock has given you a very decent return in 1 or 2 months, you may exit completely, because when you first buy a set of stocks in your portfolio, you don't know which one's going to move ahead first or which one's going to be a laggard. So maybe we would redeploy. Secondly, across the time, maybe it's a longer running stock. Maybe it's moving gradually to its intrinsic value. But at that point, we would look at its wave 1, wave 2 approach and wave 3 approach in terms of how close is it to that intrinsic value, as well as what is the market doing and what is the stock price doing? Because sometimes you enter into a frothy area, or sometimes you will find, as mentioned, a laggard stock, whether in that sector or in your portfolio, and you will moderately reduce your position and ramp up into the laggard type positions. So really, it's a multiple of factors, but this is really the overall dynamics.
Right. Now, in fact, in a portfolio, I was looking at the data, and you invested 80% largely in equities and the rest in debt and cash. So did you increase your cash holding recently, given the fact that Indian markets are trading near record highs?
Not so much, but just as a correction, ballpark, we're around 10% cash and debt, and 90% we're in equities.
Equities.
But we did increase, as mentioned earlier, from a ballpark 5% to 10% to create that cash drag when there were headwinds, but not really because markets are at record highs. Because essentially, when you're looking at maybe an index, that may be 50 stocks, but there's over 1,000 stocks listed in the universe. So not all of them are at record highs. So again, we will continually be screening for well-valued stocks, and our kind of hunting grounds are not at the 60, 50, 30, 40 end in terms of PE, and we're not multiples of books. We're looking at like 1 or 2 book maximum, and we're looking at around 10 PE maximum on a normal basis. And these kind of sectors are like the hard sectors: steel, cement, infrastructure, packaging. So these are the kind of sectors we're looking at, and where we see relative value, we would enter them essentially.
Right. And have you added any stock to the portfolio recently, or made any early exits?
Nothing dynamic. So nothing recently that comes to mind.
Right. Now, let me also quickly come down to the last question, and definitely it's more global in nature. So what are your views on the rate hike cycle, deployed by central banks globally, and how will it impact equity markets, not just for India, but across the globe? And we also have seen Germany getting into a technical recession recently.
Sure. So again, I mean, we'll experience market cycles, we'll experience business cycles. So it's not necessary that we're Again, we're looking at the 10-year story, and
10
for
years.
us, as we both know, they're hopefully very good tailwinds for India. So again, maybe the interest rates are increasing, but if you look at India specifically, it's less than what it was 10 years ago. And India has never been like at that 0% rate element. We've been used to inflation, we've been used to interest. So again, it's moderate in the grand scheme of things. For an Indian company, it's pretty moderate. Of course, there may be liquidity flows from equity to bonds, but that again is more from a top-down allocation perspective, and may even give you opportunities to enter at a more reasonable price. And so, I mean, that's how we really look at it. These things will hopefully just come and go. 2 years ago in 2021, there was no end to the bull cycle and to the froth of the market. Even a JPEG of a monkey was worth millions of dollars. But today, would anyone really put their money in this JPEG again? One would hope. I mean, it's all subjective, but one would hope not. So really, these are dynamics that are par for the course. In terms of Germany entering a recession, that's good information. But again, it is just part of business cycles. So again, we're just playing for the long game, seeing what's reasonable, seeing what has long-term tailwinds, and just looking at moderately at good companies, good opportunities at reasonable valuations.
Right. Well, on that note, thank you so much for your time, Arun. And that's all for now. But do stay logged on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time.
Thank you. Thanks.